We're ready. Let's go.
Hey, hey, hey. So today we're honestly super excited from the special guest that we're having. David Lyon has an incredible experience within any market basically for 44 years. That's meant that I really appreciate as an entrepreneur and as an entrepreneur, especially within the markets. He's a man that I really appreciate, and it was important to me to bring him on to just spare his knowledge across our community and to help more and more traders to evaluate their own skills and their own talent eventually, and to continue and to start and continue to maintain their trading experience and their hobbies, what
Mm.
they like, and especially if you want to become a professional. So David is the right go-to guy. So happy to have you here, David.
I will also
It's an
add
incredible
that,
pleasure. And I would
yeah,
love if you can tell a little bit about yourself.
in fact, I will also add that this is our 12th episode, and yeah, it's a pleasure to have you here.
All right. Well,
So,
thank you.
what is your story?
Okay. Well, 12, I'm a numbers person, and 12 is an important number. Seven's an important number. So, yeah, I had very humble beginnings, started on a farm in Western Nebraska, at a very young age, 5 years old, 10 years old, with my parents, my dad teaching me, just trading in actual things like cattle and chickens. And that might sound a little ridiculous, but I learned a lot of things from that experience. And then just really had an interest in trading. I think my original entry into trading was silver futures. And so I grew up around commodities, started trading that, and got involved in the brokerage side of it, the sales side of it. I worked for different companies, back in the introducing brokerage days, setting up, over 120 offices for a firm out of St. Louis. Of course, a lot of that was all tied to the Chicago Board of Trade and the New York Mercantile Exchange and those, back to the commodity roots. But I can tell you and your listeners that we live in such an exciting time as far as trading because I'm a lifelong learner. I believe in lifelong learning. I believe there's something new to be learned every day. The markets are very fluid, very dynamic, always changing. And so I think in that regard, you got to keep your mind open to new processes and new technologies. And so even though I started, like I say, really at the bottom, I don't know how many years, maybe 10 or 12 years in futures. I didn't have a lot. I don't have a lot of experience in options. I mean, I wanted to at one point. I remember when you mentioned options on the prelude here. I remember one of my big options trade. I actually owned a brokerage firm, so I had like 40 offices from maybe 26 states and a couple of foreign IBs that were part of that. And I made this options trade in silver futures, and and it was at the end of the trading day. And I thought, well, options, it's pretty low risk. I mean, I had put a lot of money at risk, but I thought, well, I'm okay, because it's an option. And since I owned the firm, I came in the next morning like at 4 a.m. And back then you have these big computer printouts, and they were a couple inches thick. And I looked through it and I saw that one of our traders or one of our clients through one of our offices had this huge multi-million-dollar margin call, and I was irate, because I'm like the owner of the firm, and I'm like, what's going on here? Who is this person? Which office is this? I'm going to get to the bottom of this. And then I looked at the code next to the account, and I realized it was my code. It was my account. And so my first big options trade, I had actually made a decimal point error. And I don't know, I put on like a $30 million position. And needless to say, I wasn't prepared for that type of a trade. And so you learn by doing. And this is one of the things, trading is hard from the standpoint that there's really no textbook. You don't necessarily go to a university and learn how to do this. There's so many different styles, so many different personalities. I guess that's what you guys work with, in working with so many great traders and legends and so forth that are out there. Everybody's got their own
Mhm.
style and their
Exactly.
own
Exactly.
technique. So, and we've all had our influences. Like my early influences were people like that I studied, like Fibonacci and W.D. Gann, and of course Elliott Wave and John Bollinger with Bollinger Bands. But then I got into like Ed Thorpe with gaming theory. I started studying the psychology of the market because having owned and worked in the brokerage side of the business, I saw a lot of accounts trade. I saw a lot of traders trade. I saw a lot of them make and lose a lot of money. Um, Matter of fact, in doing, statistical analysis, maybe more than 90%, I saw more than 90% of the traders losing money. And of course, a lot of it wasn't that they made bad decisions as far as the trade itself. It's just the human emotion side of this is what really caused a problem, like emotions like fear and greed and hope would get in their way. Maybe they'd make brilliant decisions and then they'd get up to a certain size and then they would blow up because of those emotions. And so, from futures, I went into stocks and I worked in the hedge fund business and did research and development. I worked with a lot of programming teams around the world, and some of those teams or some of those programmers, that I liked their work. I purchased everything that they built, that they built to date, and that they are building because I believe in intellectual property, and I like to explore new ideas and new concepts, and then sort of go through what that means to me. And so my latest last really got involved in prop trading, and previously I really had been more of a position trader or a swing trader. And I should say too that I really had decided, after going through the futures and the stocks, and even seeing how CFDs worked and so forth, I really became just a Forex specialist. And so I set up a company, research and development company, e-algo.com. And with that company, of course, I need to say it's not really, for me, it wasn't about the business aspect of this. It's like, and I think maybe a lot of your viewers and you guys can relate to this because I have a passion for this. Okay. So even if I did it for free, or probably, I'm sad to say, probably if I had to pay money to do it, I would do it because I just every day it's exciting. You wake up, you're trying to solve the puzzle, right? You're trying to solve problems. And I think that's what I learned, like I say, as a boy growing up on a farm. It's all about problem solving. You had to make work with what you've got. Not everybody is a Renaissance Technologies and has $1 billion budget to hire all these data scientists and quants and programmers and mathematicians and scientists and engineers and things. And so then what you do is like I say, the exciting time we live in is, you can look on the internet and there's so much information out there and so many great tools. And back a little bit on my background, I mean, I've been searching, I've been on a quest, right? So I've been searching for answers. At this point, I probably have written or recorded like 30,000 pages of quantitative research. Like I say, it's a 40-year plus career. I've built or had built over 1,000 different algorithms. But anymore, that's not a big deal because there's applications out there. They can build 1,000 algorithms in less than an hour or even in a few minutes. So what I thought was like a big deal, now it doesn't seem like it's such a big deal because technology and I'm working on a project, for our daughter. She's going to set up a quantitative trading firm, and I have an interest in that. And so we've been looking at, how do we do that? Looking at neural networks, genetic programming, cybernetic trading, based on my beliefs as far as that the market's always evolving. You always need real-time adaptation because one of the things that I found when I had created, over 1,000 different algorithms is that sometimes those algos work for a while or work very well even, and maybe even work for a year, maybe 18 months, but then they quit working. And so what changed? What's the dynamic? And I've seen it on the discretionary trading side too.
Do you have any explanation as to why it stopped?
Well, I know that on a discretionary side, sometimes having worked in the broker side of the business, sometimes it's the number. So like when traders, make a certain number, they change. Sometimes like a trader could make a really big hit in the market, and then because they made so much money, all of a sudden they think they need to change the way they do things, and they get really conservative, or they just psychologically they change. And as far as automated algos, as you've got your basics as far as mean reversion, breakout, momentum trend. You can, high frequency trading, scalping. But what's interesting is we have all these time frames of data that we can look at, right? So I mean, you can look at yearly data, quarterly data, monthly, weekly, daily, and then you break it down into hours and minutes and seconds or milliseconds. Um, and what's interesting about really looking at the short-term trading, and that's what I learned from the prop trading, it really got me to focus on the short-term aspect of the market. And what's fun about that is you can see maybe weeks or months or even, probably not a year, but you can definitely see months of trading activity or at least weeks within a day. Sometimes there's days where you'll see it in a mean reversion, it's building for something, you'll see a breakout, you'll see a momentum, maybe a big run up. If it's highly volatile, you might have a big run up and a big run down. And of course, the market, it's about liquidity, it's about volatility. Um, Depending on how much money you want to make, if you're trading a low mean reversion market or a low liquidity market or a low volatility market, I should say, then you can't expect to make a high volatility return, right? Those two things don't go together. So you sort of have to know the environment that you're in. And I think that algos have personalities too. Of course, they've been programmed by people. And so that algorithm, each one has its own personality and sort of its own space. And how I view the algos, and really how I look at the neural networks or any of this, or even portfolios, because recently I've been testing portfolios. I've been looking at like over 900 different portfolio combinations, right? And of course, each one has their own personality. But what you're really saying, or what I'm saying, is that these are simply tools. And so I still think that the human, or us as individuals and personalities, that we do have a place. This is sort of a hybrid approach because humans, with our brains, we can be smarter than the systems and we can be smarter than the AI. But then there are other things that the AI is actually better at because, if I have to crunch through, say, I don't know, look at, just take like 200 markets, like you did 200 markets, you wanted to look at 12 different time frames, and maybe I've got 60 parameters, and you say, okay, David, which one of those, what's the best system, or what should we choose, or what's the least, maximum drawdown system? Well, my brain thinks differently than, say, a machine. So the machine, the AI, the machine learning, can process that literally in minutes, if not, an hour or two. It just depends on the architecture that it's on. If it's a 64-bit, I mean, I've seen systems that can do well, like 50. Well, yeah, some of it's just ridiculous because it's like 50,000 systems in a couple of minutes. So I mean, there is definitely a place for these networks and these systems because, but then at the end of the day, the human, you as a trader, you need to decide what is it that you're trying to accomplish and what are your goals. And then you still plug in the data because somebody once taught me that trading really boils down to math. And so everything is a mathematical formula. And so, if you want to make more money, you're going to risk more money. If you don't want to risk that much money, you're going to risk less, but you're going to make less. But bottom line, it's a mathematical equation. And for me, I love that because I can deal with that. Once I get that down, and like I say, you don't have to be a quant or a data scientist. You can just put it out on an Excel. And once you know your parameters, like your account equity, whatever asset class you're trading, What is the risk that you want to risk? Say on some of my stuff, I'm looking at risking maybe 1/100th of a percent. Maybe over a 24-hour period, I only want to risk maybe 3/100ths of a percent. What's my risk reward? Is it 1 to 10, 1 to 20? Um, you know, my stop, I trade with stops, I limit my risk. So, break even stop, where does that kick in? And I like average true range, because the things that I do, and the reason why I look at a lot of different systems, is I believe that each market has its own personality and its own characteristics, just like a trader would. That's sort of a unique way to look at it. But like crude oil is different than gold, and gold is different than the S&P 500, and you've got your different indices around the world, and maybe that's because of those personalities or systems that are trading in that space, right?
Would like to ask you a question, David. I'm sorry to
Okay.
interrupt
Okay.
this. I'm sorry to interrupt because I want to, over the time we're running the podcast, I learned that as long as the trader is more experienced, you should let him go because he already know what to tell and how
Okay.
to educate how to educate the audience. And by the way, you were doing it great, but I want to ask you a question
Sure.
to really caught my attention. Um, you have worked with a brokerage and you have saw multiples, thousands upon thousands, it might be more, by the way, of trading accounts traded by you retail traders. And you saw all these hypothetical successful trading patterns like head and shoulders, double top, double bottom, and all this shit. And I would like to ask you why the statistics remains the same over the years. Why 90% of traders, not now it's 94% of traders can't make money. And by the way, they will, an integral part of that 9%, 94% of them will lose money in the markets and they will never ever be returned. And you have an incredible humble beginning. Well, I know you, and I know your story from how you liked that problem solving when you were working on with your father in the farm. So that was really fascinating me the way that you have started. But I just want to ask you from a perspective that I wasn't I'm not a farmer. I'm just a typical guy from a city.
Most of the
And
people
and I
aren't
want
farmers,
to ask
so
you, yeah, most of ours are not farmers, yeah. So basically, I want to ask you how, within your standpoint, how would you identify the psychological approach of Richard traders, and how would you approach your standpoint? Because there is a significant difference between the two, and why you are so successful. Besides the fact that you like the problem solving and they might not, why you're a super successful trader for over 40 years of experience and the rest are not.
Okay. Well, that's a big question. There's actually a
That's a
lot of
really
questions.
comprehensive question, but I want
Yeah,
to give a
there's a
story.
lot packed into that, because as you were saying that, when I don't have the access now, other than just looking at consensus, like I can look at a different brokerage firm, and a lot of them produce statistics as far as sentiment and consensus, so you can see how many traders are in a particular market. Are they bullish or bearish? That type of thing. But I can tell you that one of the things that your question prompted me is that, what I saw was not only that the majority of the traders lost money, but it wasn't that they lost money and stayed away. A lot of times they lost money and then they would regroup and then they would come back. So they would earn some money or get some money from somewhere, and then they would be back, and then they would back, and then they would lose again, and then they would be back. And sometimes they would get, maybe each time they'd get a little bit more down the runway before they would blow up again. And so I really think, because the other thing that I didn't really talk about, I mean, I talked about studying like W.D. Gann and people like that, but one of the things, I guess, in my journey I was asking myself the same questions. I mean, I knew that a lot of people lost money because of human behavior, like I mentioned, the emotional side of it, because they just get destabilized at some point, and it's like they think left, but they do right. They think right, they do left, and they do the opposite of what they should do when they really shouldn't do it at the worst possible moment. And so that's why the majority lose money. And then I think even the ones that do system trading, people overtrade, and so they do it too big. They're like, okay, I want to make 10 million. Say there's smaller traders. I want to make 10 million this year, and maybe they're just unrealistic. Or maybe they do really well, and then a black swan event comes up, and they get
Yeah,
wiped
but
out.
what's unique about yourself? You had a really humble beginning. And well, it's a different world right now because
Yeah,
it's much more expensive.
yeah.
Mommy and daddy demands more, and there's a smaller reliability of the academic institutions and everything else, and people wants to be called entrepreneurs, and it's not that simple to live in nowadays time, because of those things, and people want to have an instant gratification out of their workloads. And
Right.
you have loved the game since the beginning, and you had the right humble starting point, and the rest of the people don't. So, how would you suggest those people? And by the way, I know a majority of the people that I'm talking about right now. Um, how would you suggest them to start their own humble beginning and to have the right feeling, a good feeling that they do the right thing at the right time, and they do have a consistent progress, and they make something fulfilled.
Okay. Well, and I have some friends. I talked when I talked to you guys and got to know you better, which I really enjoyed. I mean, you know that I have three kids and different age spans and so forth, and so they have an interest in the business, and then they have friends that are interested, and so I've been exposed to what you're talking about, and I've had several of my kids' friends come to me and say, "Hey, I want to do this, but it's just so overwhelming. How do I do it? How do I get started?" First of all, I think it's the greatest business in the world. And the reason why I always come back to like Forex, or depending on where you live, maybe CFDs, I would even prefer over Forex if you're non-US. But what I like about it is it can be very granular, which means that you can, in that environment, you can start with any amount of money that you have, no matter how small that is. I mean, it could be 10,000, 5,000, even $1,000. So you can get started with a small amount of money. And even if you didn't have any money, there's plenty of firms that they offer demo accounts and simulated trading and things like that. And you have to be careful with that because it's a great training tool. It's a great way to learn a platform. I mean, I do it. If I pick up a new platform, I always start with a simulation or a demo on it, because the last thing I want to do is do some million or multi-million dollar trade and be like, because I'm human, and I'm like, oh man, oops, I clicked the wrong thing, and now I did. I mean, I just did it the other day. I was just trying to load a new platform, and I did a move that I would have done 44 years ago, and I actually clicked on the screen, and it was a live trading account. And I'm like, why did I do that? Now I'm in a trade with no stop, nothing. It was nothing. It turned out okay, but um, I so like with my young friends, a lot of times, because as I was mentioned before, I started studying traders, great traders, and so some of the good places to look for that is like the Jack Swagger. He's got the Market Wizards book, and so there's the Market Wizards, the new Market Wizards. Though you can get those for like $5 or $10, and I don't care if you have a lot of money or you have little money or no money. I would suggest reading about those traders because it talks about their personalities, their different styles. There's a lot of great information. And what I did is when I started reading books about traders, so I wasn't really interested in going out and buying somebody's trading systems or trading strategies. There's a lot of scammers. There's a lot of false things that are out there that people, it's just marketing, right? They're just trying to sell you stuff. And then you get it. And for one, a lot of it's a black box. You don't even know what's in it. You're not going to learn anything from that except probably a bad experience. Where if you take the time and you read about these people, I would highlight the things that I really thought were important, or I would write them down. And of course, you can do that on your iPad, just highlight it. And then I would have my own version of Cliff Notes. And so I could take a book, 500, 600 pages and maybe boil that down into about 20 pages of Cliff Notes. And then the thing is, I've studied hundreds of traders, and the good and the bad, the ones even that blew up, because I'm like, okay, why did they blow up? A lot of times it was over trading. They got
That's
too
a really
confident.
interesting
They lost their
approach.
humility. Yeah.
That's a really interesting approach, but I would like to turn around for a second and to
Okay.
ask you, what's your own, I'll call it dirty secret, to learn a trader? How do you learn a trader? How does this process even begin? Because it's a complex problem, and we're actually solving it automatically, algorithmically.
Right.
And I know the circumstances of solving such a problem. This is a way comprehensive than it sounds. So how would you, David, tackle the problem, and how would you learn new traders each and every single time?
Well, I I've always been of the opinion that you learn trading by trading. Okay. So, but the only way to learn trading by trading is you have to start out small. You can't, like, if you come in with both guns blazing. I remember as a kid, I believe it or not, I mean, when I was really young, I mean, I got out of high school early, like at age 17. I was working in oil field construction. I bought My first place was a mobile home, and I bought it. And then I bought, within a couple of years, I mean, things were going good. And I bought, a house that was several $100,000, and I sold my mobile home. But anyway, my mobile home was only like $7,000. Of course, remember, I'm old, so things have changed price wise, but it was like $7,000. And this was how I started trade. I mean, I was already trading, but I put in an account, and I don't know, I guess it was probably 3 months, but it went from seven to 21,000. But then one day there was a black swan event that happened, which was with the U.S. was the Russian grain embargo that happened over the weekend. Actually, Friday after the close of the market, the president, I think it was President Carter or so, announced the Russian grain embargo. I might have the president wrong, but anyway, over the weekend it was catastrophic, and the market opened, and my account that I had taken from 7 to 21 went to -1. Okay, so the positions got liquidated with the stops at a -1. And of course, that's when I was like, oh, I better go back to the drawing board and learn more about this. But I think my biggest mistake was I was over trading. So, I was learning. And I believe that the only way you can really learn this is to do it, because there's just there's no silver bullet. I mean, sure, it helps to have information and sort of get your own style. Each platform's different. There's different, find what trading indicators or what things that you like. But at the end of the day, all that matters is the market price, because trading, there's not any gray area in trading. It's very black and white. So at the end of the day, does your account have more in it or less in it? Did you make money? Did you lose money? That's where the mathematics comes in. So you got to be able to do some math. You don't have to be a mathematics wizard, but you got to do the math, and you need to have self-discipline. So I guess part of that trading formula is you got to figure out who you are in yourself. And sometimes it's maybe even more important to not understand what your weaknesses are over what your strengths. I mean, it's good to know what your strengths are, but you got to know, like I struggle, I struggle with self-discipline and self-control. And so then you know, if you know that, then you have to put certain restrictions in to make sure that you're okay. I've been able to trade, you know, with e-Algo and just trading for myself. You know, e-Algo, our main e-Algo. We've got a couple of e-Algos, but our main e-Algo is actually our family office, and I've traded $3 billion worth of FX, actual FX in that. And so the first thing that I would tell you in
Wait,
your
I would like to stop you because
yeah,
$3 million worth of
3 billion.
valuation just trading foreign exchange.
Yeah,
Now the daily volume is for the FX market. Fix me if I'm wrong, by the way. It's approximately $7 to $8 billion each every single day
trillion,
traded.
trillion,
Trillion.
trillion.
7 trillion.
That's the
Yeah,
big aha moment.
yeah, that
Yeah,
is true.
I
That
yeah,
is true.
I got confused. I got confused
If
within the
if
B and
you
T.
if you look at the International Bank of Settlements, they do a report every 3 years. And the last report they did, the forex market is in multiples bigger than all the equity markets in the world put together. And that's why I love it, is because it's liquid, the spreads are tight. I mean, obviously, if you trade a third world current currency, then of course your spreads are going to be big. But if you trade any of the majors or even some of the minors, the spreads are tight. It's very efficient. Brokerage firms are, the execution cost is efficient. There's good liquidity, but you also have to remember that in the event of a black swan or some high impact event, the bid ask spreads can widen out very quickly because the market makers and their computer systems, they can pull away from the market. So what seems like a very efficient, very highly liquid market, you still have to be careful or you're going to get bit, because if you get into a situation like I got into when I was young and all of a sudden the liquidity goes away, now your risk, you know, the standard deviation of your risk might have multiplied like 10 times. So yeah, $3 billion in FX really is nothing. I mean, there's people that are you know, can blow that away, you know, in a month. And it, you know, that took
Maybe
me
less. Maybe
yeah, and
less.
less, yeah, less people that can do it in a day. But here's the point I wanted to make though, is that the first step in trading isn't even so much that you can make money. Can you survive? Can you trade and can you break even? So can you trade $1 billion worth of currency and not go bankrupt? You know, that's my question. Can you do
By the way,
that?
how do you, yeah, and I would respond to you with a question. How would you manage, how would you manage such an incredible amount of money within a position? If you enter the market in just one single position, let's just hypothetically pretend that you don't, um, you know, diversify within your trades. How would you manage such an incredible amount of money within one trade?
Well, for one, I didn't do that in one trade. You know, it represents thousands and thousands of
Hypothetically
trades.
speaking,
But the other thing is that, which you might find interesting, I don't know. But do you know that the $3 billion that I traded was in one market,
of
which was
course.
the pound yen? Yeah, the pound yen. Because
Yeah.
I looked at I went through a time in my life, and I like I said, I built 1,000 trading systems. At one point I had 21 VPNs, or you know, virtual private servers. I had 21 of them running a total of like 430 algos all at the same time. So
Oh my goodness.
I was trading
I, I,
24
I
markets.
imagine I
Yeah,
imagine
24
the
markets, six systems on 24 markets on three different accounts average. So 400 and some algos running simultaneously all the time. Um, but you know what happened is, it was a good experience. So that year I made 60% rate of return. Okay, return on investment was a net 60%. But a friend of mine said, "Well, how does that break down?" And I really didn't know. I mean, I knew I was a busy guy because I was, every time I turned around, I'm updating Microsoft Server, you know, on 21 VPSs, and I felt like an IT person, really, because all of my job was really IT, just trying to keep the stupid thing running, right? Because I did it by myself, okay? And but my friend said, you know, I'd be curious to know sort of what the quantitative data is on that. And so I did. I broke it all down, and I was shocked. What I found out is that out of all of that trading, all of it came from primarily one market, but there was a second market that helped. So two markets, and all of it came from one system. So all the other systems, all the other trading was treading water, making money, losing money, breaking even, making a little bit of money here and there. But then there was one strategy, which I'll just tell you guys because you might want to know, but it was a breakout strategy. And so it was a breakout strategy, just that would, I won't give all the particulars of it, but it would execute on a breakout. It utilized a stop, and then it had 5 profit targets, and then the profit targets were based off of ATR, average true range. And the reason why I like the average true range is that that's market specific. So each market has its own volatility and its own range. And so that's what's beautiful about that, is that you want everything to be just for that market. And so in looking at Forex, what I found is that the pound yen actually has the closest resemblance to like the S&P 500. So instead of me trading like the NASDAQ or the S&P, I just trade the pound yen. And I find,
I would like to stop you for I would like to
okay,
stop you at that point.
yeah.
The same resemblance as the S&P and the Nasdaq. Am I correct? Is that what you
Well,
said right now?
yeah, that's what I said. And
Can you
it
please
may not
explain
be
it?
a minute by minute, but over time, like remember the markets in '07 and '08 and '09, when the market,
Gotcha.
I think that's the market. Yeah, well, yeah, because the market took about a 50% hit, right?
Mm-hmm.
Okay. Well, if you look at, like I did an analysis on all the different Forex pairs, and if you look at the pound yen, it also went down 54%. So the S&P went down about 52%. The pound yen went down 54%. And then, of course, I've got all the quantitative data that I did on all the other markets. But you have to realize too, on the pound yen, it has a couple of nicknames. One is called the Dragon, and then the other nickname that it has is the Widowmaker. And so what it taught me is, by trading the pound yen, and what I mean by that is it has volatility, just like the Nasdaq has a lot of volatility. But the fun thing is, about if you pick a market like that to trade, you have to get really good at it, at trading volatility. And then, how I've been able to survive, of course, is I use stops, and they're very tight stops. And so, and especially like looking at the prop trading space, where they only give you like maybe a 5% drawdown, even on open equity, on open profits. So the thing is, like I've had times where I made a bunch of money. I was in a swing trade or something and gave back all of that money, or most of that money. If you do that with prop trading, you're done. You blow your account. So those are the things that helped me sort of hone my skills as a trader, was precision. The other thing that I think you might, and you just stop me whenever you want, but something that you might find interesting, that I really found interesting, and this is after like 30, 40 years of trading. I did a study on the pound yen, and I decided, because I'm just like you guys, I've asked myself these same questions. And I'm like, because there's been times where I was ready to give up and just say, you know what? Okay, so I'm not Jim Simons. I'm not, just pick any great trader. So, I've been humbled many, many times. And just when I thought I had all the answers, then I had another lesson coming where I got humbled once again. So now, of course, hopefully I've learned my lessons. But I really felt that the answers to the trading was in the, and we talked about this the other day, but it was in the price action. And so I set out on a quest, a journey with the pound yen, because I was just doing all this R&D on my own, like I say, more like a hobby, a passion. And so I decided to take the pound yen, and I would just put it under the microscope. And so I tracked it every day, on a 5-minute chart. I tracked every move, 5-minute chart, for 7 years. And you know what
For
I
how
found?
much? For 7 years?
For 7 years. Yeah, for 7 years. And
What was the
I
outcome of that research?
Well, here's what's really interesting. I know you're probably like, you got to have something better to do, David, than than to do that. But that's another story. But but the outcome really shocked me because during that time frame, the pound yen had some really strong price trends. But in FX, the increments are measured in pips, or you could say pennies. Like if you looked at like a stock, it's like pennies. Okay, so pips. Do you know when I measured each of those waves on the 5-minute chart on a 5-minute basis, on a daily basis for 5 years, because there's about 265 trading days a year times 7, that the number of pips up versus the number of pips down is like 49% to 51%. And that's when I realized, I'm like, whoa, I'm missing the boat, because I was looking at long-term position trading and longer-term swing trading. And I'm not saying that's a bad thing, but for my journey and for me, I thought, I'm really missing the boat, because I looked at my past and my trading career, and I'm like, like for 2020, when the in the 4 weeks, the end of February to the third week of March, I made 120% rate of return. So I made 120% rate of return. I actually thought, from a position swing trading basis, I thought the market was going to continue down, and I left my position on. And that was a big mistake, because by the time I cycled through the whole year, I got to the end of 2020 and I ended up booking a 20% rate of return. But I had been up 120% rate of return in March. And had I have done nothing else, if I would have just liquidated, I would have been like one of the best traders all of 2020, because I booked 120% rate of return. Boom, I'm done. But what I realized through my study and all of this is that I was looking at things too long term, because there's plenty of opportunities short term to just go in. It's almost like if you've done any martial arts or fighting. Like I'm only like 5'8", and I'm not that tall. My arm length is not that long. My leg span's not that long as far as for kicking. So if I'm sparring somebody, I got to stay out. So I'm there. I'm on defense. But if I go in on offense, like if I'm watching the opponent and I'm like, okay, there's an opening, I'm going in. All right, I'm going to go in, but I can't stay in, right? Because of my stature. If I stay in, if the guy's like 6'4", I'm going to get killed, right? I'm going to go in. I might get a cheap shot in, but then he's just going to pound me on the ground. So that's what I learned trading, is like, go in, strike, get it, get out. And then what's fun about this is that, here's another analogy. It's like gaming theory, like at a casino. So if I could have like 100 gaming tables, so there's 100 blackjack tables, and maybe I have a computer system that's monitoring each table, and then that computer system says, David, go play table 21. Everything is ideal for you to play that. I can go in and play that, and then whenever the statistics are not good, I can get off. So that's what I like about this too, is you can selectively go in, get out, go in, get out, reset, keep your equity safe. You have any other questions? Sorry.
No, no, no. No, I don't want to stop you. In Hebrew, there is a word that called moak, which is like combat officials, and you have so many of them within the combat official combat stories, like, and you got so many of them in relation to the markets, and I'm incredibly ambitious about hearing more. And on air, I would like to invite you to part B of our podcast.
Okay.
For sure.
And I would, and I'm 100% sure that our audience will fall in love with the content that we're providing together, especially you. Or just the distribution. And I would like to ask you one more question. That will be a short one.
All right.
But I would like to finalize the part A of our series of episodes with that question, and I would like to ask you for one lesson that you have learned trading one instrument, one lesson that you have learned over trading the pound yen. What is the most important lesson that you have learned over your 7 years of tracking 5 minute candles within the pound yen? and how have you implemented it within your trading game?
Okay. Um, well, you can see my screens behind me, right? And of course, those
Yeah,
screens, they can break down into like 64 screens, but sometimes I can be my own worst enemy. And so I will remind myself, keep it simple. And your question is a simple question. And really, it's a very good point that sometimes you can overthink the problem and you can just go off on tangents because everything's a tool. Like you can have all these different indicators, but at the end of the day, you need to figure out, okay, what's going to be the best thing. And what I learned with watching those moves, besides the fact that it was 50-50, so you got to be willing to buy, go long as well as go short. Just don't get locked into a bias like buy, or sell. Be willing to go back and forth. But one of the tools that I really like is standard deviation. And if you look at a chart, even, I was doing a 5-minute chart, but you could even look at a 15-minute chart. So you could expand on that a little bit. And you just look at a simple standard deviation, and maybe you look at a standard deviation of 1 and a standard deviation of 2 and a standard deviation of 3. And if you do nothing else but you buy when it hits into the 2 and 3 zone, and you sell when it gets into the up in the 2 and 3. The other thing though is that sometimes the market, when it's going exponential and the bands are widening and it's outside of that 2.0, that's a great time for high frequency trading where you can add positions with trailing stops, and so you can really exploit that. But I have found that the market, because it's all a vibration. It's going up and down, up and down, up and down. And remember that a lot of this trading is being done with computers. And so what you can do is you can actually use that to your advantage and say, okay, how am I going to beat the house? How am I going to beat the computers? Because the computers are all based on math and they're looking at standard deviation. And so in some ways you don't need to beat them. Some ways you just need to join them. So if they're based on these certain things, then simply do what they're doing. And as an individual, of course, you can leverage that to your advantage, because if you're a big quant firm or a trading firm,
you're not able to do it. You're not
yeah,
able.
you're
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 competing on the
powering the
same book.
Titanic. Yeah, you're running a big ship. But as an individual, you're just like, hey, like my sparring example, you're going in there, boom, 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 out. Thank you very much. If you're a small trader, individual trader, you're like, I made $1,000 today, $2,000. I got it. I'm out. Tomorrow's a new day. I'll come back around, right?
That's incredible. Alan, have you heard of
For
the
sure.
last tip? We could break the market that way, just following the trend. No, I'm actually learning how the instrument is actually behaving. Look at the price is an incredible approach. And I think that, the attribution of like a big ship, and especially to big firms and big institutions was incredibly educational, because I have had an example to look at. So it will really, like, enable me to have like a deeper understanding of your message. Um, Obviously, on part B, we'll be going to be diving deeper
Okay.
onto your more and more and more knowledgeable experiences that you have had over the years. And I want to thank you, David, for your participance today and for your presence in the market and for everything that you're doing, because you're obviously making a phenomenal job. So I would like to thank you.
Definitely.
And it was
Thank
an
you.
incredibly
Thank
honor
you,
to
David.
have you here. And we're excited from Pipe B.
Yeah, well, thank you guys, and work on your questions, and I'll try to make sure you get your questions in. Okay.
You did way better than you think.
Okay.
So thank you. And part B is on.
Okay. All right.
Yeah.
Thank you.
Bye bye.
Bye. See you.